Hello everyone. The Reserve Bank of Australia cut its benchmark rate 25 basis points to a record low 2.75% this morning. I discussed this possibility yesterday in our midday comment when I noted that most of the indicators since the last meeting have been disappointing and said that there seems to be room for an asymmetrical response. No change might not cause Aussie dollar to rise that much, as it's already in the market, while a rate cut could cause the pair to fall significantly. That's exactly what happened, and comments after the meeting from RBA Governor Stevens left room for further easing, which I think is likely to keep the pressure on Aussie dollar despite the rebound in commodity prices overnight. The pair broke through significant support at 102 the figure and bounced at 101.80, but now 102 the figure seems to have turned into resistance. Technically, it looks to me like the pair could decline further to 101.50, and a break of that would probably mean testing parity. Elsewhere in the market, we don't have many economic indicators out today, but the ones that are out are likely to be of more interest than they would be usually because of ECB President Draghi's comment yesterday. He repeated what he said after the ECB meeting, that we will be looking at all the data that arrives from the euro area economy in the coming weeks, and, if necessary, we are ready to act again. Note that he said weeks, not months. German factory orders from March therefore take on additional importance as a leading indicator of German output, even though the PMIs for April are out already. The forecast for the data is bad, down 0.5% month on month versus up 2.3% in February. Now the bad data is to be expected given the fall in the manufacturing new orders PMI in both March and April. Markets said when releasing the April figures that, quote, manufacturers recorded a fall in new orders for the second month running during April, and the rate of decline was the fastest in 2013 to date, unquote. Also, French industrial production is forecast to have fallen 0.3% month on month in March versus a rise of 0.7% in February. Again, here too, the dreadful French manufacturing PMIs have made this figure a bit of an anticlimax, but in any event, we expect bad data that is likely to pressure euro-dollar further. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.